In the previous session, we discussed the profit and loss statement, which explains how a company performs financially during a specified period. We looked at how revenue flows through different expenses to ultimately arrive at net income, the bottom line of the business. Now we move to another important financial statement, which is the balance sheet. While the profit and loss statement shows performance over a period of time, the balance sheet shows the financial position of a company at a specific point in time. A balance sheet provides a snapshot of what a company owns and what it owes at a specific date. Think of the balance sheet as a photograph of the company's finances at a particular moment. Every balance sheet follows a simple and important equation. Assets is equal to liabilities plus equity. This equation must always balance, which is why it is called a balance sheet. Assets represent what the company owns, liabilities represent what the company owes, and equity represents the owner's claim on the company. Let us explore each component in more detail. Assets are the resources owned by the company that have economic value. They help the company generate revenue and operate its business. Assets are typically divided into two main categories: the current assets and non current assets. Current assets are assets expected to be converted into cash within 1 year. Common examples include cash and bank balances, accounts receivable, inventory, short term investment. Let's imagine a company which has cash of $50, inventory of $100, and accounts receivable of $100. The total current asset for this company would be $250. The non current assets are resources that the company uses for more than 1 year. Examples include land and building, plant and machinery, vehicles, software, technology, etc. These assets are often referred to as fixed asset or property, plant and equipment. In our example, company has machinery of $250 and factory building of $400. So the total non-current asset of the company would be $650. And if we add the current and non-current assets, the total assets of our company is $900. Now let's look at the liability side of the balance sheet. Liabilities represent the company's financial obligations to external parties. These are amounts the company must pay in the future. Like assets, liabilities are usually divided into current liabilities and non current liabilities. Current liabilities are obligations that must be paid within 1 year. Examples include accounts payable, which is money owed to suppliers, short term loans, salaries payable, taxes payable, etc. In our example, the accounts payable is $100 and short term loan is $150. Total current liabilities of the company is $250. Non current liabilities or long term liabilities are obligations which are due after more than 1 year. Examples would include bank loans, bonds issued to investors, long term lease obligations, etc. So, in our example, if we assume that the bank loan is $200 and there is no other long term liability, so the total liability of this company is $450. Now comes the third part of the balance sheet, which is equity. Equity represents the residual interest in the company after liabilities are deducted from assets. In simple terms, equity is what belongs to the owners. It typically includes two main components. The one is the share capital. Share capital represents the money that investors contribute to the company in exchange for shares. If the investors have put $100 in the business, the amount becomes the part of share capital of the company. The second part of equity is retained earnings. So, retained earnings represent the cumulative profits that the company has earned but not distributed as dividend. Remember the net income we discussed in the P&L statement? A portion of that profit is often retained with the company to fund for future growth. So if the retained earnings in our example is $350, so the total equity for this company is $450 and equity plus total liability is $900, which is equal to the total assets of the company. The balance sheet helps investors and analysts understand the financial strength of a company, how much debt a company carries, whether the company has enough assets to support its operations, and the capital structure of the business. Investors often analyze ratios such as debt to equity ratio, current ratio, return on equity. These ratios help evaluate the financial risk and stability of the company. To summarize, the balance sheet shows the financial position of the company at a specific point in time. By analyzing the balance sheet along with the P&L statement, we gain deeper insight into how a company operates and finances its growth.